Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. See next to hashtag GEOFF, Geoff Gannon. If you want to see what I say about him on Twitter from now on, type it in. Hashtag GEOFF, the number one value investing podcast in the world. Geoff, how's it going today?
It was going well. How's it going with you?
Why is it not going well anymore? You don't like that intro?
We can stick with that intro.
No, that intro is great. You know what somebody said? They're like, you should trademark it if you guys ever want to start a mutual fund or something like that. I'm like, yeah, that sounds like a. Okay. I'm not like, what do they call that? Superstitious. But that just does not sound like a good way to start. But anyways, hope everyone is having a great day. If you're watching on YouTube, hit that subscribe button, thumbs this video up, bring you a ton of content, having a lot of fun doing it. And of course, if you're listening on the podcast side of things, rating and review goes a very long way. If you want to sign up for quickfs.net, which is the website that Geoff and I use every single day to pull financials. It's $35 a month. Make sure you tell them that you heard of them from Focus Compounding, and that will give us a piece of that monthly subscription price. So in today's podcast, we're going to be talking about investing during high inflation. And we sent out a poll like what we talked about in the last podcast. And the question is, which stocks work best and which stocks work worst? And this is actually the topic that got the most engagement. I think people were really interested in it. And I wonder if that's almost like a good sentiment check of everything that's going on right now in the market with the Fed printing and, worries of inflation. And somebody actually said, what about deflation?
Right.
So I figured why not, just go all over it. But I guess before we do that, and remember, we have a lot of new listeners, like on the YouTube side of things and stuff. What is inflation?
Oh, well, that's a harder answer. That's a harder question to answer than it sounds like. Inflation, I guess the best way to describe it would just be the generally accepted way of describing it is it's a rise in the general level of prices.
Okay.
The usual definition that's used in modern times is a rise in the general level of consumer prices, although they do measure other things like asset prices and wholesale prices, but those are not usually what people use now.
Okay. So then what is...
And general level, meaning like they use baskets and things like that, but medians and means and things like that.
And then how does that, I guess, tie into the investing process or when you think about valuation? Because a lot of times you'll say, and maybe if you get 1% to 2% inflation, you could tack that onto your IRR. So how do you think about it when it comes to that?
Right. And that's wrong for the most part from what evidence we have. There's very little evidence at all that actual returns on equity of the average company has anything to do with inflation. So from what we've seen, we had deflation in the 30s, we had inflation in the 70s, stuff like that. There's extremely little evidence that those things that economists and investors believe is true. Some companies can do it, but most can't. So you had some of the lowest returns on equity in the U.S. In nominal terms. At the same time, you had some of the very highest rates of inflation. Mm-hmm. So, but it is very important for some companies because they can pass it on completely. And I think it's easy for people to overlook that, like See's Candies, for instance, at Berkshire, was so successful because it was a period of high inflation. It would have been a successful investment anyway, but why it blows away all sorts of other investments is because of inflation during that time. Which stocks do you think, typically perform well then in inflationary times? There's a lot of people that are worried about inflation right now. I'm seeing a lot of tweets about gold. I'm seeing a lot of tweets about cryptocurrency. Every time the Fed talks, the chairman came out, we're recording this on Monday. He had a 60 Minutes interview on Sunday, and they were pretty much saying we flooded the system with money and we will continue to do it. We're not out of bullets, negative interest rates, even though they don't think they need to do it. That's not off the table. They have tons of ammunition left. And then I'll see a bunch of tweets by people saying, buy gold, buy gold, buy gold, buy silver. So other than that, but let's talk about like from a business perspective, what type of stocks, what type of companies are ones to, I guess, search for and keep in mind that are going to benefit from inflation? Sure. So unfortunately, from a real return perspective, it doesn't really get better. So the companies that necessarily do really well in inflation they will perform much better than other companies on a relative basis, but it doesn't mean that their actual real returns will usually be that much better. So even if you take something like See's Candies or something, for a large part of its performance, I'm not sure it actually outperformed oil or gold. Now, eventually it did, but that's a good indicator for you of just how hard it is to get a better real performance from it. But what they will do is better against other stocks. So inflation generally is very bad for many businesses, so it won't be as bad for these businesses that do well. So the simple thing is it's not really based on what industry they're in or something like that. It's a timing thing. So if they have a valuable asset, that could be tangible or intangible, that's funded in the past in old dollars, and they can charge for it in the future in new dollars, then that's very attractive. And they'll return really high rates versus in inflation. So like, for instance, we have an investment we never talk about. That's a large investment of ours. That investment, how it will do relative to other investments depends in large part on inflation, because all of its assets have been bought in the past, land and animals, and require no reinvestment in the future. Mm-hmm. And so because of that, any price increases and stuff don't require you to actually buy more animals. They breed on their own, or land, you already own the land. So it obviously could be fine as an investment without inflation. But what would happen is that versus other kinds of investments that we also own, it would do much better in inflation than those things would, because basically you're not putting meaningful CapEx back into it. And yet you are raising prices. But that also works for intangible things too. Mm-hmm. So like See's Candy already had the brand name and stuff like that. If you're trying to build a brand name now, it doesn't really work, because obviously ad prices and things 10 years from now, if you have a lot of inflation, will be a lot higher. So just not having a lot of assets doesn't really fix the problem. Say gold or something, right? So gold as a commodity, you can easily analyze how it would do in inflation, right? Although it's hard to analyze what the price is really compared to other things. But a gold miner, it's kind of hard, because is the gold miner going to try to explore for more mines? Are they going to acquire other things? What are they going to do? Mm-hmm. Now, if you take a trust, like a royalty trust or something, as opposed to a actual oil company, or a timber trust instead of a company that might actually acquire more timberland, then you have a much easier way to figure out if inflation will benefit you. So that's a big part of it with like Berkshire. Seas didn't then go out and try to buy Russell Stover, because that doesn't work, because if you try to buy Russell Stover, then you have to pay a really high price for it. If you try to expand with new stores and things, then you have to pay really high prices for that. So actually things like royalties and trusts work differently. So like ExxonMobil might do fine in inflation, but actually a trust that just holds royalty interest could do even better, mm-hmm. because you're guaranteed that they won't try to buy more oil. You'll just get an increase in the price of oil over time,
mm-hmm. So I guess this really brings into the topic then of price increases. Buffett always talks about, a business that is so wonderful that you could raise the price of whatever it is and customers keep coming on back. Mm-hmm. And you just sort of talked about that. So how does price increases then factor into like inflation? Is it really just being able to raise at the rate of inflation, being able to raise more than inflation?
So the big thing is whether increases in your price have any effect on the physical amount of volume that you do. And the easiest way to do that is in cases in which the company has like almost no physical assets. The thing that like Buffett really, I think, invested in and found a lot of success with in high inflation times was companies that benefit from advertising. So ad agencies and also ad supported companies. So things like Facebook and Google, which get ad revenue, are basically able to get the same amount of GDP, nominal GDP, regardless. So let's say advertising is 2% of GDP or something, and let's say Facebook and Google end up being half of that or whatever. Then they basically have a royalty stream that they can take, which is 1% of nominal GDP. And that'll be true whether nominal GDP is 10 times larger or not. It has nothing to do with, there's not any real physical volume to advertising.
It's intangible, like a service.
Yeah, exactly.
Intellectual property.
Yeah, then that's why he talks about that as like toll bridges that way. And newspapers work the same way.
Mm-hmm. I'm kind of curious. So, to my surprise, mm-hmm. a very popular podcast recently, and to my surprise, maybe because we don't ever really talk about anything like financial planning or anything like that. You were talking about, pulling income from your portfolio and how you think it's going to be challenging going forward. Mm-hmm. So, what does the investor do who maybe, for example, inflation is going to be high, market returns theoretically a lot of people aren't projecting to be high? Mm-hmm. What do they, do? How does that tie into this like financial planning process?
Yeah,
of living on your income or living on your assets, your portfolio.
Yeah, it's hard, and it's
like, what do they do?
You don't want that to happen. If that happened in the 70s, so if that were to happen, that'd be devastating, because so like if you look at someone's portfolio in the 30s versus the 70s, while people think that stocks in the 70s did much better than the 30s. If you try to retire in the early 70s versus trying to retire in the early 30s, it could be much worse in the early 70s, depending on if you had other things government assistance, which you would have had in the 70s and not in the 30s, and pension things and stuff would have made it different. But put that aside, if you were trying to do it completely on stocks and bonds, you would have been in a worse place actually in the 70s going through for the next 15 years or so, because the inflation was high at the same time that stock prices were declining. So actually you had real declines that were steeper in terms of how much of your savings you were eating through by selling if you were doing that. So it is a very big problem and it's hard to avoid. The biggest risk is that, and actually the book 100 to 1 in the stock market, which was written in the early 70s, and the last edition of The Intelligent Investor that Ben Graham wrote shortly before he died, also written in the early 70s, both underestimated the possibility that inflation would accelerate further. They both thought that if you had depression-like conditions or bad economic conditions, they could only happen when you had like deflation, because they remember the 30s. So they both kind of, I don't want to say, Ben Graham literally advocated too much holding bonds at that time. The bond yields looked attractive. You could get things that looked very attractive at 6.5% and 7.5% interest rates, but within not that many years, short-term rates are at like 16%. So they went a little bit higher than that eventually. So those didn't work out that well, those bonds. And unfortunately, worse than that, those were some longer term bonds often, right? So they're not as short term as some things we talk about today. So one thing he did smart is that he said, even though I think bonds are a lot more attractive than stocks, and by the way, within a year or so of when he wrote the book, that would have been true. Stocks did terribly for the next 2 years or so. So he was absolutely right that stocks were expensive. But he said, because of risks of inflation and stuff, I still am advocating a 50-50 bond and stock portfolio, even though literally I think that if you were market timing or whatever, 100% bonds seems more the appropriate thing to do now. You can't do that because what if inflation accelerates?
And because a lot of people do the whole 60-40, right? Allocation or, that. So I was just kind of curious about like when it comes to like the purchasing power, and how that ties in with inflation, for people's financial needs.
Yeah, I think I give people the sense that I don't like gold or something like that. And I don't have an opposition to gold as a small part of your portfolio that is something that you have mixed in with other stuff where you're worried about inflation, and especially if you rebalance it. So if gold is like 20% of your portfolio on one side, and on the other side you have things that would like long-term bonds and that aren't inflation protected or something, is the other 20% on the other side, and 60% in the middle is stocks or something, that you over time adjust those things. So if gold doubles, then you cut it down a lot. If it halves, then you increase it, versus the other things. But I just think that it can work as a diversifier, and same things when we talk about bonds and things, but you have to understand that in general, these things have lower returns than stocks over the very long term. And so even now I would be cautious. I mean, they're not very attractive returns that you can have in stocks. In bonds relative to stocks. So you're still taking a risk if you have like overweight those things. So if I sound not optimistic about stocks, I never want people to think that means you should be putting more into bonds. You always want to buy the asset that has the best returns over the long term when it's not clearly overpriced. So my problem with gold is, how do I know it's not clearly overpriced? And there are ways to try to figure that out. But I would be cautious of anything that's seems clearly overpriced.
Sure. Which stocks then work best? So we talked about like advertising companies, businesses that may have more intangibles. Right. What else comes to mind?
So almost all of the very big tech companies would do very well. Mostly they've already gotten to the size they are because they have these amazing assets that they developed, and they don't have to do anything to redo those things. There are other things that are capital intensive that are fine. They actually could be pretty good, but it really depends on how much they reinvest in stuff. And so you'd have to have an idea for what management's plans are. Even things like a lime quarry, even things as capital intensive and not so much of a natural resource as a cement plant. If you knew that they were going to not reinvest a lot into that plant necessarily, if they had a lot of years left in terms of their access to resources and things like that, and if they weren't going to go and buy something. The big problem, a lot of it, is the capital allocation thing, which is for investors in public markets more of a problem. You're not controlling the capital allocation. So you want to be very careful about companies that are going to actually buy more things in the future and to even use your shares to acquire other things, like that. So stuff that basically you have a royalty stream of some kind, and literally sometimes royalty stream things. I think you've talked. I think you did an interview where you talked to someone about a cemetery company, right?
Mm-hmm. Yeah.
And also, I don't know if I've ever mentioned it, but I did write up Mills Music Trust, and there are other things like that, which is just a set of copyrights, things like that. And actually, lots of trusts can't really buy other things and stuff. Any of those sorts of things. It could be intangibles like that, or it could be actual land and stuff like a cemetery. Mm-hmm. But that wouldn't work if that cemetery was intent on like going national and buying up all sorts of other ones. Like a chain of funeral homes buying each other up is not the same thing as one cemetery that won't do that. So something where the asset, they're not going to reinvest in future dollars.
How do you think Berkshire will perform in a high inflationary environment?
Much better.
And is that because of C's or
utilities and railroad and insurance? Actually, insurance is not that bad in inflation. So yeah, I think all three of those those are the three biggest businesses, and I think they do really well.
And then what about
I think
banks?
Berkshire's been badly held back in the last 20 years or so because inflation hasn't been as bad as Buffett's kind of prepared for.
Wow.
He's always very inflation concerned, maybe sometimes too inflation concerned. Some of his decisions many years ago about some commodity stocks he bought and stuff, I think were purely for inflation concerns.
So like what?
He actually bought some things associated with aluminum, oil. He had a pretty big position at one time, I think, in ExxonMobil, going back 40, no more than that, years. So I feel that a few of those were, there's actually a couple other ones. They're much less well-known companies. But yeah, so he did a few that I feel were really associated with inflation concerns. Yeah.
What about PetroChina? Do you think that was?
No. I think that was just a very cheap valuation company. Yeah.
That's interesting. So what about banks?
Banks and insurers are interesting. They can do okay. Banks and insurers, if well run, don't do that badly in inflation or deflation. There can be some issues. Very fast inflation did cause problems for insurers. Buffett wrote about it in, I think, letters in the 70s, where he kind of was making fun of them because insurers had decided. So insurance policies like auto insurance and stuff used to be annual. You'd renew annually. And now people may notice that you renew every 6 months. And there's not a good reason for that today. There's not much inflation and stuff. But in the 70s, there was a very good reason for it, which is that prices at sometimes for fixing the car, but especially for jury awards and things like that, were increasing 10% in half a year. So you didn't want to wait till they increased like 20% in a full year. And so they insisted on switching to a 6-month policy renewals instead of 1 year. But at the same time they did that, they went and bought long-term bonds. And so he was kind of making fun of them because at the same time that they're saying we can't accept fixed prices for a year, they would then turn around and have fixed prices for 20 years in their bond portfolio. So it depends on the portfolio of the insurer. And we've talked about that before. There are some insurers that go very far out and stuff, and that would be a concern. But there are other insurers that don't. Very, very few insurers have big allocations to stocks the way Berkshire does.
Sure.
But some do have very short-term portfolios, yeah.
What about deflation then? So I guess I guess surviving in a deflationary environment the exact opposite of everything that we just talked about? They reinvest a ton.
That's the interesting thing. So
what causes deflation?
Well, what causes inflation? No, the simple way is what causes inflation is too much money chasing too few goods, people would say, although also assets could be the answer. But deflation in general would be the reverse of that. So you'd be having too many goods and not enough money. But the real reason is that usually it has overcapacity. Okay. So, and that the thing with deflation that's a little more complicated and why people don't like deflation and are worried about it, economists and stuff, has to do with the things that come along with it. So, like take the COVID-19 thing and stuff in this area, right? So you were building a certain amount of hotels, you're building a certain amount of retail space, office space, things like that. If you're building at a rate expecting job growth of 5% a year for the next couple of years and it's flat, then you now have overcapacity. So why do you have deflation? Because you have to cut prices to fill up your capacity. The issue where it comes in as more of a problem usually, like the Great Depression or something, right, is because the main reason is borrowed money. But if we put that aside for a second, it can't really happen with very quickly used up stuff. So you may see that there's a big change in like maybe people produce too many eggs because there was a run on eggs and now people are calm about it or whatever. Okay, that just works itself out. Egg prices collapse. It's not a big deal. But when you get into things like real estate and stuff, it takes a very long time for those markets to clear, and the things last for too long. And so that's usually where you have deflation. So we've had deflation in plenty of things, from factory things to railroad things and stuff. And sometimes it's been very severe. And sometimes as an example of deflation, in the late 80s, early 90s, there was actually deflation in the Dallas area. There was not in people's wages and things, but certainly in real estate and for banks, there was deflation basically, and a lot of banks failed. So it can happen in those places. But at the other time, it's hard to know, because when I said inflation, I'm mostly referring to things that happened in the 70s, right? Or, mid 60s to early 80s. And in deflation, we're mostly talking about the 30s. The truth is that you had very sharp deflation in the very early 1920s. And then you had quite a lot of inflation during the 20s. And then you had deflation again in the Great Depression. So people forget the fact that there was this really severe deflation over like 18 months or whatever. And then they remember the one that like lasted a decade. And that's the same risk that we have now or whatever. Anytime we talk about like depressions, recessions, whatever, people are thinking of that one time that it happened. There's actually been, like for Buffett talked about this in the annual meeting, but the truth is that until, if you take the entire history from like World War I, the founding of the country, to World War I or something, there's basically no net inflation or deflation. In peacetime you have deflation, and wartime you have inflation. And that was basically the way that it worked throughout that whole period. And now we have a different set of things happening.
So do you think there will be inflation going forward?
I don't know the answer to that. So I think I can say the same things that most people can say. There have been the seeds of things that can cause inflation, if not reversed, sown. But inflation is not caused by just increasing very basic money supply. But that does create the possibilities for credit growth and stuff later on, which eventually, if it causes inflation in certain things, is possible. But the other thing that's tricky is that I said inflation, I define inflation the way most people do today, which is an increasing the average price of consumer goods. It is much more likely and more possible that you'll have inflating of certain asset prices and things immediately when you do the kinds of things that we're seeing now. And we've seen mild inflation in the 21st century, but we have seen severe inflation in certain assets at times. So asset bubbles, whatever you want to call them. So like housing bubbles or stock bubbles or whatever. So is that inflation? By the definition we use, it's not inflation. But it seems to have a similar cause, right?
So what does the listener do then? Is it like more of a be aware of it type of thing? Is it more of a you can't really control it, or is it more of a hey, look to implement companies that could benefit from it? I mean, what, like why even? Is it just like an awareness?
Why worry about it and stuff? Because your entire investment will be wiped out in real terms if you pick wrong.
Okay. So how does the listener take that notion and implement it into their investing process?
Sure. So like, let's take a company, IEH Corporation, IEHC, done very well and stuff. If there was very high inflation, I have no idea if they would produce any earnings, any owner earnings, any free cash flow to you, because they have very high inventory growth and stuff over time that basically eats up all of their returns anyway. So you can see that in them. They're not big free cash flow generators. So it's a good business for a while like that, but it can become a big problem. We've talked about Tandy before or something. Even if they had success and growth, it could be a little rough for them in inflation. And you can see that just by looking at them. Whereas, so if all of your investments were in things like that, that would be a bit of a risk. The thing is, you have to think in terms of, Buffett talked about like, would we write pandemic insurance? I mean, like after the pandemic.
Maybe the time to write pandemic insurance so after the pandemic. The
time to think about is when no one is factoring that in. So I'll give you an example. You asked about Berkshire. Yeah. I honestly think that Berkshire's performance is in part, a meaningful part, due to low inflation. And that if there happened to have been high inflation for the last 20 years, people would think Berkshire was doing amazingly well.
So you're saying like their lack of performance to the S&P 500.
Right.
Or what a lot of people talk about.
I think some people think that timberland has been a poor investment. It won't be a very poor investment if inflation is high.
Yeah.
Stocks went up a lot right? At the same, like, let's put it this way. The price of things like the S&P 500 and stuff or their multiples were increasing a lot faster than like prices in the real economy.
Okay.
If that happens, that's very bad for timberland because people compare it as an investment versus stocks. And they say, look how well stocks did from 2010 to 2020. And look how little inflation there was. But if the reverse happens, like happened in the 70s, stocks go nowhere for, they're flat. And the purchasing power goes down a ton in that same 10 years. Then something like timberland or something looks great. So I think it's important to look at, have some things done badly for a while for real reasons, or have they done badly for reasons that have to do with inflation? And I think using the Berkshire example, would railroads, utilities, and insurers do as well or better versus other kinds of stocks if there was a lot of inflation? Yeah, I think they would have done relatively better. And so sometimes people are like, well, I'm not going to buy utilities. But if there's a lot of inflation, you regulate utilities. If there's a lot of inflation, you might want to buy regulated utilities. You might want to buy timberland. You might want to buy all sorts of other things like that. And so should it be part of your portfolio? Maybe. I think you should be aware of what components make up the return.
Sure.
Right. And so a manufacturer or retailer, inflation has, it doesn't really add to your return as far as I can tell, looking at things historically. I don't believe that IEHC, for instance, that stock would necessarily have better returns in inflation. Timberland would. So you're kind of, if you prefer that kind of stock to something like timberland, what you're saying is I'm betting on inflation staying the way it is. You're not thinking it through like one way or the other, but you're just thinking, well, if you're taking the last 15 years of anything, you're just saying, okay, I'm expecting more of the same. And the important thing to keep in mind is that the big turns in these things tend to happen off of levels that are very low so that no one thinks that things will get higher. Like we just talked about the 70s or whatever. That follows 30 years after when municipal bonds were yielding like 1% right after World War II. And everyone was convinced that they would stay there, and then 30 years later, everyone was convinced that inflation would just keep getting higher and higher. You can read things in like the 80s and everyone is convinced that it's just, we're going to be right back to what was happening then, when actually they're in like a 30-year declining inflation rate or something, but they're still thinking of that, right? So it's important to keep in mind that just because inflation is incredibly low now or something isn't really that helpful in knowing what it'll be in the next 10 or 20 years. So it's like pricing it. I wouldn't say you should buy things that are going to benefit from inflation, but I would say some things that might benefit from inflation might actually be particularly cheap now because they've had a poor 10 years or so.
Sure.
That tends to be how the momentum of these things work. So just to keep that in mind that, certain things are pretty cheap right now and would not be thought of as such bad performers if it hadn't been that inflation was low and if it hadn't been that other kinds of stocks were doing particularly well,
I just wonder at some point, does it become like a analysis by paralysis type of situation where you're like trying to factor in all these things? Like, so you were talking about in the 70s, they felt like it was going to stick at, 1% or whatever you referenced before. And, they were completely wrong. So it's like, are you looking for the extremes? Because I know, for example, when we were talking about Frost in the past, and when you made sort of this investment more so off of a macro decision, you were talking about how it was an extreme point. And that's typically the time when you come in with, maybe a little bit more of a top-down approach and then go from the bottom up. But it was just an extreme point. So do you think with inflation, it really, if you're going to factor into your investment decision, it's really when you're at like an extreme point? Or because you're not sitting here all day, thinking about inflation, I'm sure.
Right. I would avoid doing something that you could be ruined by high rates of inflation.
Okay. Which could lead to high quality companies as well.
It could lead you to high quality companies. However, there are some financial companies which own very long-term fixed bonds and things. And so I would avoid them, to be honest. Not because I have any view one way or the other about interest rates or something, but I don't think I would want to own a company that is heavily invested in things that are paying them fixed rates of interest for 20 or 30 years or something. I think, and in the Frost example, look, it went right back down to the rates went right back down. So that the estimate that I had that, rates of 2 to 4% in Fed funds or something in that range was more normal. Well, they're back down to zero again. So, it happened, the stock went up and then people thought those rates were going to stick and then they didn't. So it went back to this sort of thing. Now there's a pandemic, but still, that can happen. But I think I think it's important to take into account the possibility that inflation could add to your returns or not. And there's a small number of companies in which inflation could, the ability to raise prices and things along with inflation is very helpful. And I think that it's two companies that are equally positioned, except one of them has to keep reinvesting in the business and the other one doesn't. I would much prefer the one that doesn't. And so even though C's in many ways, I think is lucky investment because of how high inflation turned out to be, it still wouldn't be a poor investment without that. So I would, with few exceptions, stocks that do very well in inflation will do okay without inflation, as long as you don't pay an extra high price for it. And I would say for the most part now, there is not a premium that you have to pay for inflation protection, basically.
Well, that's my point, right? So if they could do well in an inflationary environment, maybe that's a good sign of a high quality company. You're looking at See's Candies, right? So they did well in a inflationary environment. And then to your point earlier of not paying up for it, I mean, people like to say Buffett paid up, but he still paid like 10 times earnings or something like that.
Yeah.
10 to 15 times earnings.
I agree with you for capital light businesses. For businesses like timberland and cement and stuff, if we have no inflation, their returns won't be better than the market.
Got it.
Yeah.
Got it. Cool. Well, have we ever done a podcast on inflation like that before?
We've talked a little bit about macro things like once or something.
Yeah, cool. Well, that was a lot of fun. I learned some new stuff throughout that podcast, and we hope everybody else did as well. If this is the first time you're tuning in with Geoff and myself, hit that subscribe button, thumb this video up. A rating and review goes a very long way. We're super thankful for all the support that we've been receiving. Like I said, views are up, which is great. Makes both of us happy. If you like the work we're doing, you want to support us, and you want to use the same website that Geoff and I use every single day to pull financial reports and financial historical records, go to quickfs.net. And if you sign up for $35 a month and you tell them that you came from Focus Compounding, we will get a piece of that every single month. Helps bump up that reoccurring revenue. And we're super thankful for all the support. I want to thank everybody so much for tuning in with Geoff and myself, and we will see you in the next podcast.